Good afternoon, ladies and gentlemen. I would like to welcome you to our panel discussion on deal making in India in times of COVID-19, a commercial, legal, and tax view. The panelists today will provide their views on these aspects and how they affect deal making in these evolving times. A little bit about ASA and Associates, DMD Advocates, and our speakers today. ASA and Associates is a 30-year-old accounting and consulting firm with a team of over 700 professionals spread across 8 offices across India. A major part of our focus is on foreign companies setting up and operating in India. Today, we are one of India's foremost accounting and consulting firms, assisting our clients in setting up their businesses, M&A, partner search, audit, risk advisory, taxation, and compliance issues like accounting, payroll, IFRS, etc. DMD Advocates is a full-service law firm with 75 lawyers and offices in New Delhi and Mumbai, and associate offices in other metropolitan cities of India. DMD has been representing both domestic and international clients for the last 35 years and has been involved in several landmark litigation matters and prominent transactions in India. DMD's core practice areas include corporate, taxation, litigation and arbitration, regulatory, white-collar crimes, and investigations and competition law. Our speakers today are Mr. Sunil Arora, Mr. Nitin Arora from ASA and Associates, and Mr. Sumit Sinha and Mr. Sanchit Jolly from DMD Advocates. Sunil Arora leads the taxation function at the New Delhi office of ASA and Associates. An expert in international taxation, he advises companies on operations strategy in India, structuring issues, tax planning avenues, expatriate taxation, due diligence, and devising transfer pricing policies. He has successfully defended his clients before various tax authorities and appellate bodies, including the Commissioner of Appeals and the Dispute Resolution Panel. Nitin Arora leads the Transaction Advisory Services vertical at ASA and Associates. He carries tremendous experience in partner search, business valuations, due diligence, business negotiations, and strategies. A board member to M&A Worldwide, a global network of over 40 international investment banking firms, he has worked extensively on both buy and sell side mandates in inbound and outbound transactions. Sumit Sinha is a partner with the corporate group at DMD Advocates. His area of practice includes mergers and acquisitions, both listed and unlisted, joint ventures, private equity and venture capital investments, banking and finance, corporate restructuring and reorganizations, structured investments, securitization, insolvency, capital markets, and general corporate and commercial transactions. Sanchit Jolly is a partner with the tax group at DMD Advocates. He advises and represents various Indian and foreign clients before the AAR, Income Tax Tribunal, High Courts, and the Supreme Court of India on varied tax issues, including taxation of royalties, technical services, issues of permanent establishment, and attribution of income thereof, and transfer pricing. Our moderator today will be Mr. Rashi Dheer. Rashi is a senior partner and heads the corporate group at DMD. Rated as one of the top 100 lawyers in India by India Business Law Journal, Rashi specializes in areas pertaining to mergers and acquisitions, joint ventures, asset management, fund formation, insolvency, restructuring, structured finance, and capital markets. He also has significant experience in handling complex investigations involving corporate frauds and regulatory issues. Before we begin, we have a few instructions for this webinar. Please note that all participants will be in listen-only mode throughout this discussion. If you have any questions or comments, please put them in the questions section in the chat box. The panel discussion will be followed by a Q&A. And finally, a link with the recording to the discussion will be emailed to you by tomorrow afternoon. Thank you, and over to you, Rashi.
Thank you, Kim. Good afternoon, everyone. It's a pleasure to have you all join this discussion today. My panel is going to be, obviously, they're experts in their respective areas, and I hope to get good insights from them, particularly in these times when those insights are very valuable. I'm going to format my panel in the following manner. I'm going to give you a brief introduction to the topic so that I create a context, and then I will be posing questions to the panelists, and my questions will be spread across corporate, commercial, and taxation experts on the panel. So good to have my panelists here as well. As we emerge from the initial shock of pandemic and resume life in this new normal, it is obvious that pandemic has spared no one, including the M&A markets. Deal activity in India actually had slowed down towards the end of 2019, which has actually further gotten aggravated as a result of this pandemic. After a drastic slowdown in deal activity across sectors, the deal activity is picking up pace. There is an uptrend in deal activity now. In the first half of 2020, the greatest M&A deal activity was witnessed in the domestic category for 64% of the overall deal activity. Inbound deal activity remained muted, except for investments into geo, which has been a very popular and popular investment that's occurred, which is a bit of an outlier. And then Group A ADP investment in GMR airports, a deal that was actually pre-pandemic for obvious reasons. The reason for this slowdown in inbound deal activity has been as you would expect, as a result of travel restrictions, lockdowns, inability of face-to-face meetings with targets, foreign companies facing more pressing issues in their home countries, etc. So although at the surface things do not seem quite right now, the world is readying for a golden age of M&A, in my view. A number of businesses are facing challenges related to cash flows, and investors are piling up on cash, looking for assets and attractive valuations. The crisis will give rise to new deals in sectors impacted severely. Stressed sectors such as tourism and hospitality, aviation, automobile, and real estate would see a lot of stress-induced sell-side transactions. Then there would be ambition-driven buy-side transactions as well. Given the cataclysmic change in the world order today because of the pandemic, it is imperative for businesses and life to redefine itself. Necessity is the mother of all invention, as it is said, and I expect that burgeoning of new innovative ideas and new ventures that will also stimulate early stage investments into startups that will become unicorns in the next 3 to 5 years. Further, the folly of putting most eggs in one basket is now more than apparent to the MNCs. And such companies would hopefully look for setting up base in India, primarily because of the supply side risk, in order to de-risk themselves from the supply side aspects. The Indian government has actually been very cognizant of the supply side issue and the risks associated with having all of your supply chain set up in China, and has therefore taken several steps to actually liberalize and open up and welcome foreign investments into India, to particularly with their Make in India policy. As we continue to navigate these highly dynamic times, as an M&A practitioner, one thing I could say with conviction is that deal making is not going to be the same again. Even in the best case scenario, the rules of the game will change considerably. One can expect a wide array of issues that would take center stage, such as need for reevaluating business contracts and standard clauses, identifying and addressing deficiencies in contractual structures, due diligence processes, impact on profitability and operating losses, relooking at reps and warranties, impact on valuation and post-closing obligations. For transactions in early stage and ongoing deals, investors would want to reevaluate underlying valuations. With respect to due diligences underway and diligence for future deals, diligence team would need to spend more time and effort to identify additional risks emanating due to pandemic. For example, data privacy concerns as companies shifted from work from home models. There are a number of commercial, legal, and tax issues that are and will affect deal dynamics in unprecedented ways that merit a consideration and recalibration of strategies. So to deep dive into these issues, we have a very meaningful panel today that would share expert insights on these issues and how these impact deal making and measures that should be taken to minimize commercial impact. So with that, as I said, I've structured my set of questions actually into 3 buckets, just to keep a much more organized format. I will start with, thinking of the life cycle of an M&A deal starts with negotiation and signing of the agreement. And then, all the due diligence can be done prior to that, but I have taken a life cycle where you sign the agreement, you take a period for diligencing the company, and then getting post-closing items. So my questions will fall into these three buckets, and I'm going to start with right from the beginning of this life cycle, which is on negotiation and signing. I guess the most obvious question which comes up as a result of this pandemic is, I would pose this to Nitin. In light of COVID-19, Nitin, what impact do you see on valuations, and what's the outlook going forward?
Thank you, Rashid. And I think you have put into context very nicely. In fact, you have covered a lot of information which would be very relevant for the viewer. If we talk about the valuation, I think there is no doubt that the negotiation of valuation almost constitute 50% of the life cycle of a transaction. If you take a transaction to be 9 months to a year, I've seen at least 3 to 4 months go on with the negotiation of valuation. What exactly is valuation? Valuation is basically a perception for a buyer which is willing to pay for an asset. And a lot of valuation perception is driven not only from the historical data, but also from the what future cash generating ability of the business the buyer perceives. Now, especially in COVID times, the future is looking highly uncertain. It's actually a new normal where we can't predict whether the normalcy would return in 3 months, 6 months, it will take 1 year. So valuation right now, if you ignore what is happening in the stock market, where there has almost a V-shaped recovery, limited large cap stock. If you talk largely private unlisted companies, in my view, valuations are continue to be under a stress at least for next 2 to 3 quarters, even 1 more year. But it will be unfair to say that value, everything you can't paint with one brush. It will also be sector specific in my view. Some sectors such as aviation, your hospitality, they will take much more longer time to come back, and their valuation is likely to be under a stress for longer period of time. But on the other hand, if you talk about e-commerce, if you talk about online education, if you talk about anything to do with tech, I think they have come back even more strongly, in light of COVID, and the valuations have become richer. So valuations generally will be continue to under stress. As you rightly said, there will be bargain purchase. Buyers would want to, find reasons to renegotiate a transaction and wiggle out of a transaction and try to put pressure on valuation. But generally speaking, valuation will take at least 3 to 4 quarters for it to come back to a pre-COVID period. Now that's what is happening. But going forward, two important things which will be very relevant to do evaluation in these unprecedented times are, just to be a little technical, how do you do evaluation? You do using a discounted cash flows, which is an income approach, and you use your multiples, which is a market approach. Now, market approach will be DCF, which will become a lot more prominent because history might not reflect of the true picture. So you have to calculate what's the future cash generating ability of the business, and hence the business projection will become very relevant. And on the market side, you always calculate the term called EBITDA. Everybody in investment banking is use EBITDA. Now that EBITDA is going to be replaced by a terminology called EBITAC, which is earning before interest, tax, depreciation, amortization, and COVID. So you will have to normalize all your earnings for the impact of COVID to see that you are applying a right multiple to a right EBITDA to EBITAC, I would say, to calculate the valuation. So I think these two things, in my view, are going to be very, very relevant as we go forward on a valuation standpoint.
Well, you've coined a new word, and I'd never thought about it. And I would say EBITAC. It is that we speak of. I wonder as to how we will get the COVID coefficient in the valuation, but that's a topic, I guess, for another day. But given, as you rightly said, Nitin, the uncertainty that exists in the markets, the question is, do contracts which you have signed right at the beginning, maybe you have signed pre-COVID or you'd be signing now, what kind of, and I think this is a question for you, Sumit, what kind of clauses, you typically see a clause called material adverse clause, which is inserted more to do with issues that are out of control that may adversely affect valuation. So, although these clauses are standard part of all M&A deals, it typically provide an acquirer with a right to walk away from the deal. In your view, how do you think that clause will be approached while negotiating M&A deals from now on? And what are the typical things that would be sought in a MAC clause by the seller and then by the acquirer?
Sure, Rashi. And a very pertinent question over there, Rashi, about the MAC provisions. Just like people started thinking about force majeure after COVID-19 set in, people are now also thinking about the MAC provisions. And historically, MAC provisions have just existed in the contract as a safety net for the acquirer to give them a right to walk away should the parameters on the basis of which the deal was signed is to change substantially. I think given that now we are aware of COVID and we've seen the economic fallout that COVID has had on the global economy at large, I think the MAC clause needs to be looked into very, very differently. The standard MAC provision, which provided for an overarching language, which said that any adverse change in the business assets, liabilities, future operations, or financial condition of the target will become a MAC. And typically the acquirer relied on an undertaking from the seller or the target, which was issued right before closing, to say that there has not been any material adverse effect or material adverse change. I don't think that that typical format of writing the MAC provision in the transaction documents can now work going forward. I think from an acquirer's perspective, it is very important, especially in deals where there is a long gap between signing and closing of the transaction. I think it is very important for the acquirer to link the MAC provisions with an oversight provisions, with the right to supervise the business of the company in the period between signing and closing, in order to be able to see what are the kind of what are the changes in the contractual terms that are happening for the acquirer. Are there any changes in the facilities that have been availed by the acquirer? In fact, it should be coupled with what I would say a pre-closing diligence, a short diligence, to ensure that there has not been any material adverse change, to see whether the vendors who are the top 10 or top 15 vendors are able to perform their part of the contract. To gather market intelligence on the financial viability of those vendors. Are they able to continue to perform? If some of them cannot perform, are there appropriate replacements available in the market? What would be the cost to replace? Is the company looking to default under any of the facility documents? Does the company have enough liquidity to keep servicing the repayment obligations? How is the company going to manage business continuity, so to say? How is the company going to protect data privacy, given that 50% or more of the staff would be required to work from home? So all of these things need to be factored in, and there should be a limited due diligence right, which is to be conducted right before closing from an acquirer's perspective, in order to ensure that a MAC has not occurred, instead of just relying on an undertaking given by the seller or the target. From a seller's perspective, I think it's very important to lay out in front of the acquirer as to what are the disruptions that the seller or the target thinks that is going to affect its business in the coming months. If there are certain things that the seller or the acquirer or the target, is absolutely certain about, like supply chain disruptions, employee disputes, any immediate litigation that is threatened against them, or which could actually become a substantial litigation going forward. All this should be laid out upfront to the acquirer. Though from a seller's perspective, I think value enhancement and value creation is an important aspect, but I think it's very, very important to lay out the issues that the seller thinks that they are going to face right there upfront in front of the acquirer, and carve them out as exclusions to a possible MAE or a MAC provision. Just one more point over there, Rashid, very quickly, is that what the acquirer and the seller could also consider doing is to have a more objective criteria for MAC or MAE, which could vary from let's say a 10% to a 25-30% change in the EBITDA numbers or net worth or the revenues of the company. that gives a little more deal certainty, so that both the acquirer and the seller is aware that only if there is a more than the given percentage impact on the EBITDA or the net worth or the revenues, that the acquirer would be able to call it a MAC and would be able to exercise its rights to walk away from the deal.
No, so I think that's a very good point in terms of creating an objectivity rather than living with the uncertainty that I think it's interesting that COVID, as much as it has created uncertainty, it certainly creates foreseeability and the ability to be able to now take what I call as complete outlier situation and build that. So I think your suggestion is well taken, but the one thing that is certain about COVID in many sectors is the impact on the bottom line, which is on the profitability. And so I, have to bring in the tax guys who always think about what happens to, they all, tax people always think about make hay irrespective of the situation. And so my question to Sachit is that what is the impact of COVID-19 on profitability, operating losses, and the ability to carry forward such losses?
Thanks, Rashi. First of all, I think I'm going to borrow this term EBITDA from Nitin, and I think we'll make hay on this for sure.
Yeah. See, I told you.
Sell it. But surely sell it like hotcakes in court now. Thank you, Nitin. But coming to the profitability of companies in this COVID era, I think its initial reaction for everybody was that you'll see a huge fall in profitability. But as Nitin said, and I again borrow this thing from, it has had varied impacts to varied sectors. Initially everything was down, but the FMCG sector or e-commerce has largely been, it's almost back on track. At least the FMCG has seen a huge surge in profitability. People started stocking up goods initially, and I think that's also a factor which will be relevant in deal making. That the COVID has had a huge impact in an upward way for FMCG and maybe downward for other sectors, and therefore I think those factors need to be culled in. Now, in terms of ability to carry forward losses, I think the law as of now is pretty certain in terms of business losses can be carried forward for 8 years. I don't think there's been any change in that. I hope that the government realizes and extends that period, because at least in some jurisdictions there is already some relaxation of carry forward of existing losses, and that will become an important aspect while acquiring companies, especially from an acquirer perspective, that if you are able to carry forward the loss for a longer period of time. And secondly, the other condition in carry forward of loss, which invariably we see in deal making, which becomes a hindrance, is that if the shareholding changes more than 51%, in that situation, you are unable to carry forward the losses of past years. Now, I think that needs to change a little bit, maybe in terms of COVID. You will see a lot of companies going down under in order to save them. Maybe this also needs a little bit of relaxation to say that companies acquired under stress during this period should be allowed to carry forward losses irrespective of the change in control or the 51% change in shareholding. I think those are some of the aspects which need to be factored in while looking at the COVID impact on profitability and the ability to carry forward such losses.
And I guess, Sunil, I would love to get your views. I think often losses tend to create a certain level of M&A activity. I mean, technically, they produce restructuring within groups. Do you expect that this whole stress that is happening on some of the group companies more than because of the sectoral stress, like for example, in travel or in hospitality, there are large groups which actually have many businesses. Do you expect a lot of activity to come up as a result of these carry forward losses generating more M&A? Sunil? Sunil, I think you're muted. Okay. Sunil looks like he's having a little bit of a difficulty. So Sunil, I'll probably come back to you, but let me carry on with Sachit. Um, Sachit, in terms of I would also like to understand from you, particularly in these times, people are going to look at financing, and there are certain limitations on interest deductions under the thin capitalization rules. So I would like to get your insights on limitation on the interest deductions under the thin capitalization rules and its impact on.
Yeah. So look, this provision was brought in 2 years back in the Income Tax Act, which said that if you borrow money from your associated enterprises outside India and the interest exceeds the 30% of the EBITDA, then the deduction of interest will be restricted to 30% of the EBITDA. And I think it was very relevant for a lot of companies. I'm dealing with one such situation as of now, where the company is an NBFC. It doesn't otherwise, and the NBFC also in consumer durables like mobile phones, washing machines, televisions. So they kind of provide financing in that sector. Now it's almost impossible for them to get the funding from banks, despite the best measures or best interests of the government. The banks are not willing to put money on such companies or extend loans to such companies, so they are forced to borrow money from their associated enterprises, which may be outside India. Now, in a case where your profitability is down, 30% of EBITDA will be effectively nil. And in a case where right now where the ability of people to repay loans or their EMIs is also affected and there is a moratorium, the position becomes aggravated where literally you are unable to get deduction for the interest payout, which may not be substantial, but at least it is a cost in your books. So that creates a situation of unviability for such enterprises, even in normal circumstances, but in COVID it's become worse. And I think that's something which is a factor to be considered while in deal making today, that if you are in such a situation where there is almost a negligible chance of getting an interest deduction, whether you are better off getting equity, or you structure it in a manner to have loan as a matter of extended to your group companies. That's one. Even in terms of acquiring companies today, when I, as an acquirer, I look at this provision, I would look at the accounts of the target and see whether this kind of an issue will come at a later stage, because this could potentially expose the target to a higher level of taxation than its ability to pay, because there'll be an interest payout to the associated enterprise. That will be a cost. It will be a cash flow issue. And then secondly, if you're not able to offset that against your very little profits that you may have, then it becomes a double whammy for the target, and it becomes an unsustainable business. So I think those are factors which I would look at from an acquirer perspective also when I look at a target.
Yeah. Well, I guess just as Nitin mentioned that in evaluation you have to have a COVID coefficient. I think tax people should also think about a COVID coefficient to normalize things. But I wish I could discuss more on this aspect. It was very interesting, but I think I'm going to move to the next bucket, which is on diligence, which is a very, very important bucket. And as you would expect, that diligence is a key aspect of validating and verifying. Valuations can be done. You can look at balance sheets. You can look at all of the conversations happen without looking at diligence. But diligence is the caveat emptor concept in contract law, which is buyer beware. So, which is why diligence becomes a very, very important aspect to validate things. And I think in that context, Sumit, I would like to ask you a question: that does COVID situation merit a relook at the expansion of the scope of due diligence on target entities? And if yes, what are the new aspects or facets of business that need to be part of legal due diligence?
Sure, Rashi. So I would like to illustrate this by giving an example that we are facing. Actually, we faced in a live transaction. We were diligencing a power producing company, a wind power producing company, and it had entered into PPAs with various state discoms. One of the larger sources of revenue was the PPA with one of the state discoms in the south, and they had outsourced the operation and maintenance of the wind power project to another entity. You typically don't go and look at the financial stability and viability of the subcontractor. You typically diligence a target, the target in a normal diligencing situation, and that is exactly what we were doing. When we were just trying to think through if we are missing the point anywhere, and we just happened to do a public search on the vendors, on the suppliers, and we just happened to find out that this O&M contractor has actually been put under corporate insolvency resolution and is within the period of moratorium and may not be able to continue to provide its services. And the wind power producing company, the target, is largely dependent on this O&M contractor in order to be able to meet its obligations under the power purchase agreement. That kind of changed our entire outlook towards the diligence process, and we realized that we don't only need to look at the target company now, but we need to look at the top 10 vendors and maybe the top 10 customers, gather market intelligence on their financial condition. Are they able to service the contract or not? Do we need to replace them going forward? What is the cost of replacement? So we need to now think of various issues that were not they did not belong in the issues category maybe 6 months back or a year back. From an employee perspective, we need to think of whether the various orders that were issued by the MHA were complied with during the lockdown. Did the company actually end up firing or terminating the services of any of its employees? Was it done in accordance with law? Is there a collective bargaining agreement that needs to be referred to? Did you need a consent under a collective bargaining agreement? From a real estate perspective, you need to ascertain whether all the real estate assets that the company is sitting on, does it actually need those real estate assets? There may be certain very expensive leased assets that the company may be sitting at. Is the company in a condition to terminate those leases? We do a cost benefit analysis of whether it is beneficial to terminate that lease or to continue paying the lease rent for the rest of the period of the lease. From a litigation perspective, we also need to factor in any possible threatened litigation which could actually materialize into large-scale disputes. So I think, yes, we need to completely rethink our approach towards legal diligence and not just look at the target, but look at the surrounding circumstances as well and surrounding factors, including the vendors, the customers, and etc. For us to be able to do a complete fact finding and to be able to tell whether whether the transaction is good to go or not.
Yeah. Well, I guess, you spoke about the commercial side and the legal side, but I guess same question, Sunil, to you. How will tax due diligence evolve in these times? Do you see a significant impact on your approach for tax due diligence?
Certainly, Rashi, and I hope I'm audible this time.
Yes, you are.
Right. So, Rashi, I think I would take you from what Sumit said, and he made some very pertinent points. Now, listen, when you talk about diligence, you need to talk about first the environment in which a diligence is being conducted. Now, COVID has, whether we like it or not, COVID has created opportunities on both sides, but COVID has also created a very disruptive environment. Now, this is an environment which impacts the quality of and the extent of checks that you want to make in a tax due diligence. So what is the environment that we're dealing with essentially? We're dealing with an environment where the quality of documentation is not very good, right? You were under a lockdown for 3-4 months and obviously quality suffers. There is a high level of uncertainty in what you wrote, how it was communicated. Obviously, there is a gap that you are trying to look into. You have taken some very aggressive tax positions or some very conservative tax positions in these 3 or 4 months for serving various purposes. The ability and the confidence of the management to respond to your queries have also taken a hit because they're not absolutely confident of what they are saying or what they're doing, right? So it impacts your credibility and your extent, the checks that you want to place. There could be recent reorganizations, say for example, to raise short-term cash. That could be one of the or leveraging any asset. So there could be reorganizations. There could be, for example, issues on bookkeeping. Typically a case where when the lockdown was triggered in end of March, and perhaps there were some expenses which could not be accounted for in March, and they were accounted for next year. That gives rise to an issue called a prior period expense situation under the Indian Income Tax Act. That could be an issue. There could be, and as Sumit also mentioned, there could be very untimely, unabrupt cessation of third-party contracts, right? So we're dealing with an environment which is a very open-ended, unstable, uncertain, and it's a very complex environment. So the question is, what do you do? Or what do you do differently in that scenario? So I think one of the couple of cases where we are doing diligence in the sort of covering the COVID and post-covering COVID scenario, we said we want to adopt a 3-pronged strategy, which will sort of cover and try to take care of most of the uncertainties that have arisen during the COVID time. I think the first point that you have to be very careful about is that I don't think you are in a position now to sort of follow any past positions. Any positions that you might have taken in the past must be revisited. I don't think there's a shortcut to that. And Sumit said more or less the same thing. You will have to do extensive fact finding, extensive legal findings on whatever positions the client or the target must have taken. That's the first strategy. The second strategy is that I think you will have to now work very closely with your legal teams and your financial teams. Say, for example, you're dealing with a third-party contract, and the legal diligence says that because of an untimely cessation of the contract, there is implication on the target of some liquidated damages. Now, as a tax expert, there is a direct consequence of there could be a direct consequence of the liquidated damages on your computation of income, whether it's allowable, not allowable. You'll have to examine that part. So you'll have to work very closely with your legal teams and your financial teams. Lastly, I think you have to engage with the management very, very closely. Any issue that you find material, and I can give you many issues. As I said, we've been dealing with a couple of cases. Issues could be issues in valuation of inventory. March 31st, we are all under lockdown. There are bound to be issues on valuation of inventories. Income recognition, WIP, how do you deal with that? There will be issues in inconsistencies of payment to third parties, for example, rental payments, right? FMCGs on one hand wanted to acquire more space, and everybody else who was in the non-attractive sector wanted to leave or wanted to sort of defer payments. So how do you deal with that particular scenario? Transfer pricing is another critical aspect. Sachit mentioned about associated enterprises, the impact of the interest cap. But in general, the transfer pricing will have an implication on the new term that Nitin coined, EBITDA. Yeah, because the moment you try and revise your transfer pricing, and it could be due to various factors. Transfer pricing has disrupted the entire supply chain, productivity channels, markets, geographies, your cost of capital, everything has been disrupted. So there is bound to be a change on your transfer pricing, and that will have a bearing on your valuations. And keep in mind that whatever valuations you define today, the tax officer is also going to have to look at those valuations when he will certify this under Section 56. And so therefore, there's a direct bearing on what you do here, what you certify in terms of tax due diligence, and linking it with the valuations. So I would say any issue that is material will have a bearing on the tax due diligence, and therefore our approach has to be more minute, more detailed, and more exhaustive.
It's interesting, Sunil, what you said. Taking a cue from transfer pricing, I'm sure if you were dealing with third parties, and this goes to in transfer pricing, comparable transaction is sort of the benchmark method is critical. However, given that margins are going to be under pressure from third parties, the question is, will the tax office actually adjust their margins with respect to these transfer pricing transactions? And that's an interesting question. But given the level of diligence and level of carefulness you now have to dispense in doing tax diligence or legal diligence, my question is, at the end of the day, diligence always impacts reps and warranties. So, we as consultants can be on both sides of the equation, buyer side and seller side. If you were sort of representing the target of the seller, what kind of limitations how would the reps and warranties from a target or a seller be impacted in terms of limitations, in terms of liability, and in terms of making sure there's no breach?
Very interesting part, and as advisors, that is exactly what we try and achieve. Any issues that are material, any issues that require any sort of statements are obviously moved to the reps section of the agreements that we sign. And I would imagine that if I'm on either sides, a couple of issues that I would like to cover. And as I said, we are dealing with a very complex environment, and this will obviously encourage more exhaustive, more detailed representations in the agreements that you sign. Some of the areas that I see reps being discussed in more detail is, let's say, for example, you are in a tax-free zone, you are availing tax holidays. Now, connected with an issue where you are in an SEZ, a special economic zone, for example. Now, the special economic zone, like all of us, special economic zone today also, under the lockdown, people were advised to work from home. Now, how do you claim a tax holiday when people in a special economic zone are working from home? Now, obviously, there is a window how you avail that specific benefit. There is a specific notification which was issued in 2016. But today, you must have a representation on the face of the agreement, very clearly stating that we are fully eligible to claim these sort of exemptions, because that's the basis on which the business is standing today. If you were imposed a 25, 30, 32% tax, everything goes for a toss. Similarly, any other major expenses that you might have claimed, that would require a representation. For example, any expenses you might have claimed during lockdown. Now, there is no, for example, assuming a case where there is no basis to claim that expenditure, there is no documentation to claim that expenditure. What is the basis for you to understand and allow such an expenditure to be placed in the profitability statement for the purpose of calculating EBITDA? How do you do that? So that must find a place in the representations. Typical issues like if there is an issue of permanent establishment, let's say it's a cross-border deal, and you are dealing with a case where there is a case of deemed permanent establishment. How do you deal with those issues? Specifically in cases where you're dealing with your cross-border partner on a net of tax basis. Now, when you deal with somebody on a net of tax basis, a deemed P situation means that you could be paying a tax which is a grossing up factor of 40%. And therefore you have to sort of take care that you give adequate comfort to the buyer that all is well, and we have a reasonable basis to sort of suggest that there is a case of non-deemed P. And you can pick up any issues like that, but these were the typical issues that perhaps COVID would cause in terms of representations.
Well, no, that's good. I wish I could also get such an insight, but given the time constraint, I'm very keen to actually get questions from the audience. I'm going to pose one last question, and I'll open it both for Nitin and Sumit. This is more with respect to, I want to complete the life cycle of a deal, post-closing and post-closing. In terms of post-closing obligations, what critical issues you see emerging from commercial standpoint? Nitin, why don't you give your views, and then Sumit, you can add to that. You are muted, I think.
Yeah, okay, fine. I think now it's fine. Can you hear me?
Yeah, we can hear you. We can hear you.
Yeah. So very quickly, Rashi, if you ask me personally speaking, I think the post-closing stage is even more trickier than the stage which we discussed, because when you are discussing a valuation, everything is open. You're in a non-binding stage. Everything can be renegotiated. You can create structures. You can live to fight another day. You can do a lesser deal today and link to future. But if you have signed something, it's set in stone. So if you have signed something, in my view, from a commercial standpoint, two critical issues would emerge. One is, if you have a purchase consideration which is deferred and kept in an escrow, if some amount of money is sitting in escrow and you were to get it post the completion of a particular obligation, let's say you were to recover a large amount from a client, and that's why the balance consideration would have to be released. But if the client does not pay because of COVID, what happens? Your money gets stuck in an escrow. That's one typical big ticket issue which we foresee to happen in times to come. And the second is, if you have a put option or a call option structure in place in which we have agreed to sell the balance equity at a pre-agreed valuation or a formula, and this happened in a transaction, and it's a very live case we are dealing with. Somebody sold 60% of a company at an X price, agreeing to sell the balance 40% at a 7 multiples over next 2 years EBITDA. Now, last year was bad and this year is even bad because of COVID. So he might have to sell the 40% at almost a nickel, And if the buyer was to enforce a call option, then what's the way out? So these two issues are typical post-closing issues, because you've signed to a contract and now you're stuck in a contract and the COVID has happened. So in my view, the only way is both parties go back to the table and renegotiate and try to see what best can be done, because it's an exceptional situation. And I think the role of Sumit and the role of you guys would be very, very relevant to kind of find a legal remedy on such clauses.
Sumit, I'm actually going to stop you from giving your additional insights because of paucity of time, and there are a lot of questions that have come. And so I am going to straight away go to the questions. In fact, the first question appears to be for you, and I'm going to read that question. The question is, given the COVID outbreak has led to mandatory closure and lockdown of business for a few months, what impact does this realistically have in interpreting the ordinary course of business aspects under the standstill obligation of target companies between signing and closing?
Sure, Rashid. So absolutely right. In fact, this was this was in the news a couple of weeks back, actually, when a private equity fund was looking to acquire Victoria's Secret's L brands. And essentially in that transaction, and I'm referring to that transaction specifically because it's quite on point. And in that transaction, the MAC or the MAE clause kind of excluded COVID-19 specifically, because around the time the deal was signed, it was very clear that COVID-19 is going to be an issue. So it was specifically excluded from the MAC provisions. But what the acquirer tried doing in that deal is that they kind of fell back on the ordinary costs, the standstill provisions, where the seller and the target were supposed to carry on the business in ordinary costs, and they kind of claim that you've not carried on business in ordinary costs, because unfortunately the target had to close down certain retail outlets, luxury retail outlets had to be closed down. Some employees had to be terminated, salaries had to be renegotiated, a lot of things had to be done. And the acquirer tried taking benefit of this as deviation from the ordinary course of business requirements under the transaction documents, and tried to walk away from the deal. The deal finally it was settled out of court, but that's a very important learning for all of us, that when we draft provisions on ordinary course of business, I think from at least from the target and the seller's perspective, it is very important to carve out compliance with laws and any mandatory closure or any other requirement to comply with the completely changing dynamics because of COVID-19. There are new legislations that are getting enacted. There are new packages that the government is announcing. There are laws that are getting repealed or suspended. For example, the IBC provisions, some of them have been suspended for a 6-month period. to adapt to the changing dynamics. I think that it is very important that the seller and the target have flexibility of compliance with laws, and in certain situations it may not always be possible to go back to the buyer. For example, the lockdown in India was announced at almost at a 4-hour notice. It may not always be possible to go back to the buyer and get their prior consent before you are implementing a change. So I think those aspects need to be thought through and built in appropriately, so that you don't end up violating your ordinary course business obligations under the standstill provisions.
Well, I would think so that given the COVID experience, you would have, just like at a country level, you have the Disaster Management Act, and there is a whole committee that's created. You almost want to think about creating a mechanism for disaster situations and a governance set of principles for those situations, even in a standstill clause, only because you don't have the luxury of having proper governance and proper protocols being met. There must be a much smaller committee created with disaster guidelines. And to me, as you were speaking, that seems to be one way to deal with now what is more foreseeable because of this pandemic. Well, I'm going to move to Nitin. Nitin, there is a question for you. That during due diligence process, well, I guess you may have answered this. What are the critical things one needs to factor, especially in the current situation? I think this question you probably have already answered. I guess I would take the next question. How does current volatility in equities market impact valuation multiples of a deal?
I think it's very relevant because I've already talked about EBITDAC. Now, EBITDAC is your part of the EBITDA, but what multiple you apply to that company is very relevant. So you have to look at comparable transactions and comparable companies. Now, what's the reference date you are picking up is very important. So if you're doing a valuation on, let's say, 31st March 2020, on 21st March, the stock market crashed by 30%. So all the multiples, if you take for a company listed, let's say you're doing an automotive transaction, your client is an unlisted auto company, and you're looking at the multiples of all listed companies, their multiple would not reflect the right number on 31st of March. So when you're looking at the right multiple, you have to again adjust for the 12 months trailing or 15 months trailing and taking out the EBITDA impact, and then multiply with your EBITDAC to arrive at the valuation. So you have to do your right calculation of your own company EBITDA, and the reference companies have to be also taken for a period adjusted for the COVID impact on a particular stock market date.
Yeah. Well, with that, I guess looking at the time frame, I'm going to have one last question, since you guys have spoken about various aspects of pre-closing, negotiations, and diligence, closing and post-closing. I'm going to ask each one of you to give me one takeaway from this whole situation that you would say the most important thing that one needs to watch, whether that's from a legal perspective, tax, or a commercial perspective. So, I'm behaving like a TV anchor saying, your last few words before we close. So I'll start with Sachit from a tax, and then go to the commercial side.
Well, from a tax perspective, I think two very, very important, and I'll take the liberty of saying two. First of all, the positive aspect of COVID, and I would look at that, is that the faceless assessments which have been announced from a tax litigation perspective should prove to be a step in the right direction, because I don't see, unless a vaccine is announced, people being able to go to tax offices, or for that matter, will be able to go to courts to litigate issues further. So I think the faceless assessment and appeal, coupled with the fact that all hearings are now happening online, I think that's an important aspect. And that may not strictly be from a deal perspective, but ultimately all our deals go to courts. And I think that's a reality we must be wary of, that if not a commercial, the taxman will always look at it So, if you have an option to defend it, sorry?
This is a lawyer, you wish all the deal to go. I'm sorry. Yeah, go ahead.
Yeah, but the fact of the matter is whether as part of a deal on valuation you go to court, or in terms of an assessment of the transaction you have done, whether you've done a slump sale and a merger, demerger, whatever you may have done, the taxman will look at it. And I think one thing which we need to factor in on a realistic basis is whatever we are doing right now will get picked up in scrutiny in 2 years' time from now. Our memory is short-lived. I don't see a tax officer in 2021 or 2022 giving you any leeway for COVID. You may keep fighting it, you may ultimately succeed at a higher forum, but I think their targets will be back. They will have to meet the targets, and therefore you'll see a lot of tax assessments on deals which are done at this stage. So I think that's one aspect, and then of course the faceless assessments and appeals will only help tide out of these issues at a later point of time.
Well, I guess Nitin, and then I'll take Sunil and Sumit. Nitin,
I think one thing is that you do any sort of thing, profitability is important, and if you can't control your revenues, control your cost, because profit is a function of revenue minus cost. If you can't control revenue part of it during COVID, strictly look at each and every line item of your cost and try to maintain profitability, because multiplier is on profit and not on sale. So each cost can be renegotiated. Deeply look at it. No cost is small. Try to save every cost. We do it in our business, and we advise our clients to also the same.
Well, same advice. Sunil.
Yeah, I think I primarily agree with what Sachin said. I think we have to get our house in order, because 2 years from now, nobody's going to remember what happened. The other part is that a lot of people not realizing that this is the best time that government has been really all out in sort of giving you softs, and the only softs that are being given to MSME segment, and this could be relevant from a leveraging your assets point of view, from deal making, is that any tax refunds that you have, any money stuck with the tax authorities, if you make a request now, it's being entertained today. If you're not availing this opportunity, and I'm not talking about small amounts. If you're not availing this opportunity, it's an opportunity that you're missing for life, because we have had cases where monies were stuck. In one case, more than 100 million was stuck for about 5 years, and we have got that in the last 3 months, and we have the money in our hand. So this is a golden opportunity. And then I think one needs to have a more cautious approach when you are dealing with cross-border situations, and given that you are in a very complex environment, use whatever avenues, whatever windows that you have under the income tax law, permitted under the income tax law, use them to your advantage. If there is any iota of doubt on tax withholdings, go and approach a tax officer. He's available to you online today. Go and approach a tax officer, get a lower tax withholding certificate, and get done with it. Today they are more open and more available to talk to you, because they're not busy with routine stuff. So use this opportunity.
Sure. Sumit, last word.
Yeah. My takeaway actually would be that I think we need to, given how fluid and dynamic the situation is, I think we need to, lawyers, we need to rethink and not follow the traditional ways of deal making, the traditional ways of doing a diligence, drafting transaction documents. I think one needs to factor in the moving parts and on all of the fluidity in the entire scenario, and we need to think kind of 4 or 5 steps ahead to ensure that we are looking at situations where things could be very different 1 month or 2 months down the line, and we factor in the possible difference in situation, including the reps and warranties that you're making today vis-a-vis the reps and warranties, how they will stand at the time of closing, how you need to approach the diligence process, how the documents need to be drafted. All of that has to be rethought, and I think a lot of thought needs to be given in thinking ahead, in thinking 4 or 5 steps ahead, in order to ensure that you're not missing out on a critical aspect, which may be a factor staring right at your face a couple of months down the line.
Sure. Well, excellent. Rethinking, rethought is exactly what the pandemic has done. And I would say a lot of people consider the pandemic. I'm sure all of us sitting at home have gotten frustrated, and there is a lot of negativity, but I like to look at glass half full rather than glass half empty. And I would say the one thing that COVID has certainly done for all of us is to rethink, um, is to be able to really pause and think about not just legal, commercial, and tax aspects of a deal, but generally about your life as well. So my sense is there will be a lot of innovation, a lot of good things that will come out of it. There will be a lot more, although we are all in the era of social distancing right now, but I think the need to meet people has increased, and hopefully it'll actually bring communities together. My sense is post-COVID, you're going to have a happier, better, more deal making, better valuations, better thought process behind businesses, more innovation. So a lot of positivity. And with that, I am going to thank each one of you for spending the time and giving your expert views and insights. And I wish I could spend more time, and I am going to probably do that after the call. And maybe we can do a series, episode number 1, just as we have on Netflix and Prime, and keep going, keep having this go on. So thank you all again. And with that, I think we are exactly on time. How beautiful! That's usually usually not happening with accountants and lawyers, but everything has a first, and this is the first. So thank you again for participating in this.
Thank you, Rashi. Thank you, everyone.
Thank you, Rashi. Bye.